Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, July 11, 2023, 7-11. So go out and get your Slurpees. Hope everybody's having a fantastical day out there in the interwebs. It is a beautiful yet warm day here in Colorado. So it's, what's the temperature right now? It's up to usually 88 degrees. Woo, hot, scorching. Well, for Colorado. Anyways, like I said, hope everybody's having a fantastical day out there. It looks like the markets were, in a much better mood today. Like I said yesterday, the Dow and the NASDAQ spent most of the day in the red. Today, the Dow Jones and the SP 500 stayed in the green most of the time, while the NASDAQ kind of dipped in and out of the red, but did finish in the positive for the day. And it looks like lots of green all the way through for the entire trading day. So anyways, if it's your first time here, thank you very much. I'm glad you're here. Appreciate it very much. And if you could do me a favor, please press all the buttons down here, shares, likes, follows, all that good stuff. I'd greatly appreciate it. And give me some thumbs up. All right, let's go ahead and get into the markets for today. All righty. Dow Jones finished the day up 0.93%, 317 points, closed at 34,261. SP 500 was up 0.67%, closed at 4439. NASDAQ was up 0.55%, closed at 13,760. The VIX fell 1.53% today. It's currently at 1484. Canada was up 0.28%. Brazil, the lone red here in the Americas, Brazil was down 0.61%, and Mexico was up 0.9%. Over in Europe, Germany was up 0.75%. UK was up 0.12%. France was up 1.07%. Netherlands was up flat at up 0.01%. Spain was up 0.85%. Italy up 0.68%. Switzerland up 0.37%. Same with Portugal. In Russia, both exchanges were in the green today. The MOEX up 0.12%. The RTSI up 0.45%. And the overnights in Asia, the Nikkei was fairly flat, up 0.04%. Australia was up 1.5%. Let's see here. It looks like the New Zealand market's open right now. Let's see. China, the Shanghai was up 0.55%. The Shenzhen Component up 0.79%. The China A50 up 0.56%. DJ Shanghai up 0.6%. Hang Seng up 0.97%. And the Taiwan weighted was up 1.41% for the day. Like I said, lots of green, and people must be feeling better today. We'll see what happens tomorrow. I think one of the inflation reports coming out tomorrow, so we shall see what happens there. See if it keeps people in the same good moods. All right, market recap. Dow adds more than 300 points ahead of inflation report. All right, stocks closed higher on Tuesday, driven by gains in the energy and big tech sectors as investors awaited upcoming inflation reports. Energy stocks saw a boost as oil prices rose on improved demand outlook and reports of falling crude production. Expectations of tightening oil market conditions in the second half of the year, along with the potential of stimulus measures in China, contributed to the positive sentiment. Leading the gains in the energy sector were companies like Pioneer Natural Resources, APA Corporation, and Halliburton, which Goldman Sachs highlighted for its customer mix and international exposure. In the industrial sector, 3M company surged nearly 5% after receiving an upgrade from Bank of America, citing expectations of improved performance following the settlement of legal disputes related to water contamination allegations. The rally in industrials was also supported by Generac Holdings and Stanley Black & Decker. Banks demonstrated strength ahead of the earnings season, with JP Morgan leading the sector higher after receiving an upgrade from Jefferies. The regional banks also showed positive performance, with U.S. Bancorp gaining over 3.5 following an upgrade from Bank of America. The bank was deemed well prepared to manage challenges in the sector and expected to deliver superior earnings growth and stock performance. Amid big tech companies, Amazon stood out as it kicked off its 2-day Prime Day sales event, contributing to its stock's positive performance. Meanwhile, Microsoft faced some struggles in turning positive despite growing hopes surrounding its potential acquisition of Activision, following a federal judge ruling against temporarily blocking of the deal by U.S. regulators. Overall, the market regained Overall, the market remained optimistic as investors anticipated upcoming inflation reports, with energy and big tech sectors leading the way in Tuesday's session. All right, so everyone's in a good mood for some reason. I'm not sure why. I mean, looking at all the forward-looking reports, everything looks pretty terrible right now. So, you could look at labor and all those things, which are trailing reports. I don't know. I mean, you got the yield curve that's inverted. You got a bunch of other, household net worth is in the red year over year. I mean, there's a bunch of things that I go through with clients, and it just doesn't look very good right now. All right. Next up, dollar dives to 2-month low, pound scales 15-month peaks on wage growth data. The dollar weakened, reaching a 2-month low against a major currency index as Federal Reserve officials suggested that the U.S. central bank is approaching the end of its tightening cycle. The greenback fell against the yen, hitting a 4-week low, and also dropped to a 2.5-year low against the Swiss franc. Several Fed officials indicated that while further interest rate hikes may be necessary to address inflation, the current monetary policy tightening cycle is nearing its conclusion. These comments led traders to revise their expectations for future rate increases, causing the dollar index to decline to a 2-month low. The June non-farm payroll report, which revealed the fewest job gains in 2.5 years, added to the speculation that the Fed may only implement a single rate hike in the second half of this year, which would either be probably the meeting this month on the 25th or in September on the 19th and 20th. Where was I? Oh, gosh. I lost my spot. Second half of the year. The market also awaited the U.S. Consumer Price Index report for June, with expectations for core consumer prices to have fallen by 5% on an annual basis. The outcome of the CPI data would offer further insights into the Fed's progress in addressing persistent inflation. Meanwhile, the pound sterling reached a near 15-month high against the dollar, hitting 1.2934 after British wage growth reached a joint record high. This development increased pressure on the Bank of England to tighten its policy further in order to control inflation. The euro also strengthened, reaching 2-month peaks against the dollar, and other European currencies such as the Norwegian crown and the Swedish crown were also robust. The Japanese yen saw a significant increase, rising more than 3% from a 7-month low when it breached the 145 per dollar level that alerted traders to potential intervention by Japanese authorities. In terms of other currencies, the Australian dollar was slightly higher, while the New Zealand dollar dipped ahead of the Reserve Bank of New Zealand's policy decision scheduled for Wednesday. The overall weakening of the dollar reflected the market's response to the Fed's monetary policy signals and the anticipation of key economic data releases, indicating a potential shift in the interest rate expectations and currency valuations. And I guess it was probably the summer of 2020. Talking about the dollar index, and actually let me make that bigger for you. This is the dollar index going back the last 5 years, and probably around this time, summertime, fall of 2020, my concern and worry was that the dollar would fall below 90, and we'd have a currency collapse or something like that. Little did I know that the Fed was going to print money like crazy, and all the other central banks around the world would follow suit, which in the end, you can see how the dollar strengthened over that time and peaked out in September of last year at 111. So it has been falling since that point and kind of just been back and forth between about 104 and 101. So we'll see if the dollar continues, to fall or what happens long term. But, again, keep an eye on the dollar index. Again, it's compared against the other other 6 currencies, major players that are in the global market. So granted, you're comparing it against the other bad apples in the bunch. So take it with a grain of salt. But if it's doing worse than the rest of them, that's time to worry. All right. Last up, the truth about Bidenomics, more debt and more inflation. All right. Estimates for the United States growth remain significantly below the projections made by the Federal Reserve, even after the large-scale monetary and fiscal stimulus implemented in recent years. The current consensus for real GDP growth in the fourth quarter of 23 stands at 0.2%, much lower than the median projection of 1% in the June summary of economic projections by the Federal Open Market Committee. While there are signs of headline strength, closer examination reveals weaknesses in key areas such as core capital goods orders, which have been revised down. Even under the optimistic assumptions of the Biden administration, with projected GDP growth of 2% per year until 2032 and a 3.8% unemployment, the federal government deficit would remain above 5% of GDP in 2032. This would result in an accumulated deficit of $15.46 trillion between 23 and 2032, leading to a debt to GDP ratio of 106%, even with bullish growth estimates. I think we're sitting at about 129% of GDP right now. One of the main issues of the neo-Keynesian approach to government budgets is that it leaves households with less money in real terms, and the measures taken to counter inflation actually increase debt and inflation. The American Rescue Plan, for example, was intended to provide financial support to families during the pandemic, but adjusted for inflation, Bloomberg Economics estimates that the average household in the bottom 40% of income distribution now has $1,200 less in liquid assets than before the pandemic. Furthermore, the Inflation Reduction Act, the CHIPS and Science Act, and the bipartisan infrastructure law aimed at stimulating demand and investment generate more inflation and add artificial demand to an already full capacity economy. Bloomberg Economics warns that the cost of these projects in terms of higher inflation and recession risks may outweigh the benefits, especially in the near term. The accelerated spending in such areas as clean energy and infrastructure adds to the inflationary pressures and strains supply chains, potentially leading to a recession. Launching large-scale spending programs funded by newly created money and debt in the economy already operating at full capacity exacerbates inflation and weakens public finances. The measure taken by the Federal Reserve to address inflation, which is worsened by government anti-inflation spending programs, may inadvertently contribute to a recession. The situation calls for the Federal Reserve to take action to reduce inflation generated by the government spending programs, even if it risks creating a recession through rate hikes and monetary contraction. The failure of these policies may result in calls for further massive government spending programs, which will just lead us right back to where we're at right now. So, I mean, the easiest fix for this would be just for the government, to slash their spending by, 50, 80%, pay down the debt, pay it off over, at this point, probably take 20 years, and tax everyone a flat tax across the board. 20, 25%, let the little people at the bottom feel the pain like the rest of us at the top. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.